curious about your views on the private credit side. There's been so much growth, and I know you've written a little bit about it as well. So I'm going to let you tell the audience about your views. I have a sense, but I would love to hear them.
If you just looked at the historical track record of private credit, you'd think, wow, this is a fantastic asset class. The thing is that it's kind of an untested asset class. I mean, the last time there was a financial crisis was like 2008 to 9. And the private credit category was teeny. Now the private credit market, just the US private credit market, is 1.6 trillion. When we had stock market meltdowns, like even the blip meltdown in 2020 during the COVID pandemic, I mean, business development companies fell in value more than the S&P 500. There's incredible risk there. If there's like liquidity issues, and if people, if there starts to be an escalation concern about credit quality in the economy,
Hmm.
the National Bureau of Economic Research did a careful study to determine whether private credit managers have skill. And the results were really interesting. They said, well, yes, indeed, private credit managers have skill. The annual return of the assets they're selecting is 4% per year, better than if they had selected liquid public credit assets. That was the good news. The bad news was the average fees being charged by these private credit firms, it's 4% per year. And so if you take their edge, the 4% per year that they're making from good choices, but then you
Hmm.
subtract the 4% per year they pay themselves for making those choices, then you really haven't been better off.